Imagine waking up tomorrow and hearing that the United States has just slapped a 25% tariff on all Mexican crude oil. Overnight, millions of barrels that normally flow straight from Mexico's Gulf Coast to refineries in Texas and Louisiana suddenly become much more expensive. This isn't just a trade headline, it's a direct hit to America's energy lifeline. For decades, Mexico has been one of the most reliable oil suppliers to the United States, sending roughly 60% of its exports north of the border. Much of this oil is heavy and medium crude, the exact type that U.S. Gulf Coast refineries are built to process. Without it, those refineries can't operate efficiently. That means higher costs, reduced output, and eventually higher prices at the pump for everyday Americans. So what happens if this flow is disrupted? Where would Mexico send its oil if the U.S. market becomes too expensive? And where would U.S. refineries turn to replace it? These questions are more than economic puzzles. They could reshape energy trade across an entire continent. Today, we're breaking down how a tariff war could force Mexico to pivot toward Europe and Asia, what that would mean for American refineries, and how this shift could redraw the global energy map. Over the past several decades, Mexico has steadily emerged as a crucial player in the North American energy landscape, supplying the United States with the heavy and medium crude that keeps Gulf Coast refineries running. This partnership didn't happen overnight. It's the result of years of investment, infrastructure, and shared economic interests that have tied the two countries together, in a really vital way. Mexico's position as a major oil supplier to the United States wasn't a coincidence. It was built over decades of policy decisions, geography, and shared infrastructure. For most of the 20th century, Mexico's oil industry was controlled by a single state-owned company, Pemex. This monopoly meant the government had full control over production, exports, and pricing. But by the early 2010s, oil production in Mexico was starting to decline. Fields like Cantarell, once among the most productive in the world, were past their peak. To reverse this decline, Mexico launched sweeping energy reforms between 2013 and 2014. These reforms broke Pemex's monopoly and allowed foreign companies to explore, drill, and invest in Mexican oil fields. The expectation was simple. More competition would bring in new technology and money, boosting production, and while output did not grow as much as expected, partly because of aging infrastructure and slow project development, Mexico still produces around 1.7 to 1.8 million barrels per day. Much of this production comes from the Gulf Coast region, especially the Campeche Bay area, and a significant share of it is heavy and medium crude. This type of oil is not easy to process everywhere, but United States Gulf Coast refineries are specifically calibrated to handle it. In fact, heavy crude is essential for making products like asphalt, diesel, and other thick petroleum products. This long history of cooperation, combined with the geographic advantage of being right next door, made the United States-Mexico oil trade stable and cost-efficient. But tariffs would throw a wrench into this carefully balanced system, making Mexican oil suddenly more expensive and forcing both sides to rethink their strategies. A 25% tariff may look like a simple policy lever, but in the oil world, it's like throwing a wrench into a running engine. Tariffs work by making imported goods more expensive, and in this case, every barrel of Mexican oil arriving at a United States port would suddenly cost 1/4 more. For refineries in Texas and Louisiana, that means their cheapest, most reliable source of heavy crude just got far less competitive. Many would be forced to switch to alternative suppliers, like Canada or the Middle East, even if that meant paying more for shipping or dealing with logistical challenges. Energy consultancies such as Wood Mackenzie have modeled this kind of scenario and predicted a sharp reduction in the flow of oil from Mexico to the United States. Mexican producers, facing higher costs and lower demand, would have little choice but to look for other markets. This isn't just theory. We've seen something similar before. When tariffs were placed on steel and aluminum during the Trump administration, trade flows shifted dramatically. Countries that once sold primarily to the United States quickly rerouted to Europe and Asia. Retaliation followed, tensions escalated, and consumers ultimately faced higher prices. A 25% oil tariff would trigger the same pattern, except this time it wouldn't just be steel beams getting more expensive. It would affect gasoline, diesel, jet fuel, and even asphalt, products that touch nearly every part of the economy. So looking ahead, Mexico faces a set of important choices. With the U.S. market potentially becoming less attractive, the country will need to weigh its options carefully, especially when it comes to exporting oil to Europe and Asia, where demand patterns are shifting but remain significant. If the United States becomes just too expensive, Mexico has to find new customers, and honestly, do it quickly. The most obvious places to look are Europe and Asia, where demand for heavy and medium crude oil is still strong. Europe's Mediterranean refiners, especially those in Spain and Italy, have the technical capability to process heavy crude like Mexico's Maya blend. These refiners already buy similar grades from the Middle East and North Africa, so, Mexican crude could slot in as a welcome alternative. With Russian oil facing sanctions in many European countries, Mexico might even find new opportunities to gain market share. Asia is an even bigger prize. China and India together account for a massive share of global crude demand, and both nations are actively seeking to diversify away from over-reliance on Middle Eastern suppliers. Joint energy scenarios have already been floated between China and Mexico to prepare for potential United States trade restrictions, which could make Chinese buyers some of Mexico's most important partners if a tariff war breaks out. But Mexico wouldn't just walk into these markets and get premium prices. It would likely have to sell its oil at a discount to compete with other exporters like Russia, Saudi Arabia, or Brazil. And, the logistics are much more complicated. Getting crude across the Atlantic or Pacific is slower and costlier than sending it to Texas by pipeline or short-haul tanker. Still, the opportunity is real. If priced right, Mexican oil could become part of the energy mix in Asia and Europe, giving Mexico leverage and showing Washington that it has options beyond its northern neighbor. Finding buyers in Europe or Asia is only half the battle. Getting the oil there is where the real challenge begins. Right now, shipping Mexican crude to the United States is about as simple and cheap as it gets. Most oil moves by short-haul tankers across the Gulf of Mexico, arriving at Texas or Louisiana refineries within days. But, sending that same oil to Europe or Asia means much longer voyages and much higher freight costs. To reach Asia, Mexico has two main routes, through the Panama Canal or by sailing all the way around South America or Africa. The Panama Canal route is faster, but it has strict size limits, and large tankers must pay expensive transit fees. Going around Cape Horn or through the Suez Canal adds thousands of extra miles and days of travel, driving up fuel costs and tying up ships for longer periods. Even shipping to Europe, which is shorter, still costs more than a Gulf Coast run. Those extra shipping expenses can add several dollars per barrel, eating into Mexico's profit margin and forcing it to sell at lower prices just to stay competitive. There are also infrastructure challenges. Mexico would need to coordinate port schedules, storage capacity, and long-term shipping contracts to handle the new routes efficiently. Any delays or bottlenecks could further raise costs and make the entire operation less profitable. In short, rerouting Mexico's oil exports is possible, but it's not cheap or simple. Every extra mile on the tanker map is another hit to revenue, and that's before even considering competition from other oil exporters trying to sell to the same markets. These shipping and infrastructure hurdles, they set off a domino effect throughout the entire supply chain. Each added complication can ripple outward, impacting everything from delivery schedules to global oil prices. So while rerouting may seem straightforward on paper, the real-world consequences can be much more complex and far-reaching. A U.S.-Mexico oil split wouldn't just affect those two countries. It would send shockwaves across the entire energy system. First, U.S. Gulf Coast refineries would face an immediate shortage of the heavy crude they rely on. These refineries are like kitchens built for a specific recipe. They work best with Mexican crude. If that feedstock becomes too expensive, they would have to turn to Canada, Venezuela, or even the Middle East to fill the gap. But Canada's pipeline capacity is already stretched, and Venezuelan oil is under sanctions, meaning refiners might have no easy or cheap alternative. Higher refinery costs would trickle down to consumers in the form of more expensive gasoline, diesel, and jet fuel. This would fuel inflation, a problem U.S. policymakers are desperate to avoid. It's the same pattern we saw during the steel and aluminum tariff wars, where protecting one industry ended up raising costs across the economy. The ripple effects wouldn't stop there. Canada might start diverting more oil to Europe or Asia if U.S. tariffs make the North American market less profitable. OPEC producers could take advantage by boosting their own sales to the U.S. at higher prices. And China or India might jump at the chance to lock in cheaper long-term contracts with Mexico, turning a trade dispute into a geopolitical realignment. In other words, a tariff move designed to protect American energy could end up weakening its supply chain, pushing prices up, and strengthening competitors abroad. Now, when we look at all these moving parts, it becomes clear that the consequences of an oil split or tariffs would ripple far beyond just the immediate players. The scenarios and outcomes could reshape not only the energy market, but also the broader geopolitical landscape for years to come. So, what actually happens if Washington follows through with a 25% oil tariff? There are a few possible futures, and honestly, each one paints a very different picture for North American energy. Scenario A, the tariff stays a threat. Sometimes tariffs are announced but never implemented. In this case, the policy might just be a bargaining chip. Oil traders might get nervous, but flows would continue as normal. Mexico might still explore new markets as a precaution, but there would be no major disruption. Scenario B, temporary tariffs, partial reroute. This is the most likely short-term scenario. Tariffs go into effect, causing some shock to the market. Mexico diverts part of its crude exports to Europe or Asia, but both sides eventually sit down to negotiate. We've seen this pattern before in past trade disputes. After months of tension, partial exemptions or special deals are worked out. Scenario C, long-term high tariffs. This is the scenario with the biggest impact. If tariffs stay high for months or even years, Mexico could permanently pivot its oil exports toward Asia and Europe, building new supply relationships that last well beyond the tariff period. U.S. refiners would have to find new suppliers, possibly turning to the Middle East at higher costs, and American consumers would feel the pinch at the pump. This could lead to political pressure inside the U.S. to roll back the tariffs. Each scenario has winners and losers. Shipping companies might benefit from longer tanker routes, while U.S. refiners and drivers would pay the price. The real question is whether the U.S. administration is willing to risk higher gasoline prices to make a point on trade. As we wrap up our look at long-term tariffs, it's clear that the stakes are high and the outcomes are far from certain. The decisions made now could shape the energy landscape for years to come. At the end of the day, this potential tariff fight is about more than just oil. It's about leverage, economics, and, well, who gets to set the rules in North America's energy future. The United States may see tariffs as a way to bring Mexico to the negotiating table, but they carry a very real risk, driving one of America's closest energy partners into the arms of Europe or Asia. This isn't a simple winner versus loser story. Mexico has options, but so does the United States. The smartest move might not be a prolonged tariff war, but rather a deal, one that secures U.S. energy supply while giving Mexico incentives to keep shipping oil north. After all, both economies are deeply intertwined, and a full energy divorce would hurt both sides more than it helps. For now, investors, refiners, and even ordinary drivers should be watching closely, because what might look like a policy decision in Washington could soon show up as higher gas prices at your local station. So what do you think? Should the United States push forward with tariffs to gain leverage, or should it focus on building a cooperative North American energy bloc? Let me know in the comments. This debate could shape the future of energy security for the entire continent. Thanks so much for joining me on this journey through the complex world of energy tariffs. If you found this discussion helpful, please consider subscribing, and don't forget to share your thoughts below. Until next time, stay informed and stay engaged.